Hello, guys. Today we're going to be doing IB Business Management, section 3.4. So this is a really important section in IB Business Management. It comes a lot in paper two, and you really have to be able to master it. Okay, so it comes with a lot of business finance tools. You really have to know these. So let's begin. So firstly, we have final accounts. So what is a final account? Final account is their financial statements at the end of particular accounting period. Okay. Final accounts help internal stakeholders and external stakeholders, sorry, this is stakeholders, indicate the financial position and performance of an organization. How does it do that? So we do know that internal stakeholders are internal to the business. So they work in the business, whereas external stakeholders, they're not in the business, but they're somehow affected by the business, and they do affect the business and the way it operates. So they kind of control it by their demands and whatnot. So let's begin. So shareholders, if you don't know who shareholders are, they basically buy shares in the business and then they expect returns from these shares that they end up buying. In order to satisfy the safety of their investment by establishing the profitability of the business. So basically, and the business is profitable, if the business is doing well, then that's a good thing for the shareholders. They know that things are being done right, and they know that their money is worthwhile, so the money they invested was worth it, right? Okay. But if the business is making losses and there's a problem, then the money they invested isn't worth it. It isn't worthwhile. So there's something going on that's wrong. They check how efficiently the business is investing their capital. So how are they investing their capital? Is there a lot of waste in the business? They're not being efficient. They're not being productive. What's going on? In attempt to make a worthwhile return on their investment. So they're seeing if the money that they invest in the business is being used properly, if it's being used efficiently, if the employees being hired are up to the caliber. The performance of directors is also an interest of shareholders in order to see whether the directors need to be motivated further. So whether they just need a push, whether they're doing really well, or they should be replaced because they're not doing well at all and they're not guiding the business properly. Okay. So this is it for shareholders. So this helps them basically evaluate whether their investment was worthwhile. Then you have managers. Managers basically they use final accounts to set targets, which they can use to judge and compare to another fiscal year. So they see that last year they did a better job, so they might see the new changes they did this year and remove these changes, eliminate the changes they made. Or they might say, oh, this year we're doing better than last year, so we'll enhance the changes. We'll continue investing in a certain, let's say, a machinery. Okay, so it depends. This will help them evaluate their decisions, right? Okay. And then you have these will help them in setting budgets, which will help in monitoring and controlling expenditure patterns in various departments. Okay, so they'll see, oh, okay, so we have a good amount of finance we can use. We still have money we can spend, or they can be like, oh, we don't have much money we can spend. We need to be on a budget. We need to follow this budget. This is our budget. This is what we can do with the budget, right? Whether they have a marketing campaign, whether they're investing in a new product, whether they're investing in research and development, it really depends. Hence, final accounts aid managers in effective decision making and strategic planning. Okay, so it helps them plan. Then we have employees. Employees are profitable business could signal to their employees that they are secure. Okay, so that means that the employees can keep their jobs. The business won't end up closing. The business is doing well. Um, but it can also initiate. It can also indicate that they could get a raise. Oh, sorry, this is like typed twice, but basically, however, an increase in profitability does lead to an increase. Sorry, this just this like ignore it. Can lead to trade unions to negotiate further on their behalf, meaning that the employees think that, oh, okay, so the business is doing well, they have an increase in profitability, so now we can get higher salaries because now the business can afford it, right? But that's not the case in all times. The business might not, probably won't give them a raise, which can lead to trade unions to negotiate on the behalf of the employees because the employees know that the business can now afford paying them higher salaries, right? External stakeholders. So these are external to the business. So we have customers. So the customers are interested in knowing whether the business will continue supplying their products in the future. Okay, so they need to see whether they're gonna continue getting supply, right? Then, if firms lack security due to low profitability, customers will go elsewhere and supply is reliable and guaranteed. Okay, so I'm going to give you an example of this. For example, there's a restaurant that's known to go broke. It's going bankrupt. It's not really doing well financially. So the customer like unconsciously will think, oh, well, their food's probably old, their produce is probably bad, the food they're getting isn't high in quality, it might not be hygienic, they might not be focusing on their hygiene, so let's go somewhere else, right? So they'd be scared of the produce that the restaurant is using, right? So this is an example. Local community. Residents living around a particular business will want to know profitability and expansion potential. So they want to see if there may be some new job opportunities for them and lead to a growth in the community. So they'll see, oh, is there a new job opportunity? Is this expanding? Is this something good for our economy? Or it can be that the residents may be concerned on whether the business will be environmentally friendly and whether it considers costs for minimizing air or noise pollution. Okay. Suppliers. So suppliers can use final accounts to negotiate better cash credit terms with firms. So basically, like okay, so the firm is doing well. The firm can like afford paying us a one-time payment. They have more money now, so we can negotiate a better term with them. Right? They don't have to lease them or lend them any money. Okay. Or they can either extend the trade credit period. They might say, oh, the firm isn't doing very well financially. They need a longer trade credit period. Basically, trade credit periods when like they're trading, they're giving them back. Like for example, they gave them the machinery and their business is like giving them money in like installments, in like different installments, right? So the machinery costs like $20,000. They're giving them, let's say, 5,000, 5,000, 500, then 5,000, right? And be like, okay, the business isn't doing well. We're like making them pay 4,000 per once, not 5,000, right? They'll extend the credit period, or demand immediate cash payments if the business is doing well. So here, if the business is doing badly, here if they're doing well, for example, right? So it really like depends. Now we have the security of the business and ability to pay its debts will be a concern for suppliers. Okay, so basically, if the business is going bankrupt, it's not doing well at all, the suppliers will be concerned. They think that the business may not be able to actually afford its business will not be able to afford paying the suppliers, and so this might like um ruin the relationship between the supplier and the business just out of fear, since suppliers will think that they won't get their money back. Okay. Then you have financiers. So financiers are like banks, financial institutions, basically. They check the creditworthiness of a business in order to determine how much money it can lend it. So how much the money the business actually has, how much money it's making to determine whether it's actually able to pay for the loan, or whatever deal they have, because they can get the loan, they can get other types of different types of loan, whether it's a long-term loan, short-term loan. So yeah, banks will thoroughly assess the accounts of a business in order to be confident it will be able to pay back its loan with interest, right? So whether I'd say overdraft, whether they can also check the assets the business owns to see if they have anything as collateral. So now you have government. So the government and tax authorities will check whether the business is abiding by the law regarding tax regulations, specifically the profitability of the business to see how much tax it should be paying. So now you have competitors. So basically, the government, by the way, regarding the government thing, a lot of businesses end up changing the location of their business, like the headquarters at least, in order to like decrease taxes. Okay. And like you have many laws, like health laws regarding the employees. You have employee law, like the pensions, um, like the minimum wage rate, all of these things. Then you have competitors. Businesses will want to compare their financial statements with other firms to see how well they're performing financially, whether they're doing well, whether they're not doing well, the averages of their industry. So what's happening basically. Um, they compare profitability and sales revenue. So sales revenue is basically price times quantities. They want to see how much the competitors are selling relatively to them. They want to see whether competitors are buying more, or whether customers are buying more from them or from their competitors. And they also compare profitability. So now we have a profit loss account. This is very, very, very important. This comes in a lot of paper to IB exam papers. So if you're not gonna get it during your IBA official exams, You're most probably gonna get it in your school exams at least. So this is, you're always gonna have to know, this is a very, 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 very crucial part in IB business management. Okay, so now we're going to be analyzing or like studying the profit and loss. Okay, so you have profit and loss account. So you have for a profit making entity and you have for a non-profit entity, right? So you have profit making entity versus non-profit entity. What's the difference? The difference is that for a non-profit entity, they use a surplus. Okay, they use surplus instead of profit. Okay, so as you can see here, like there's profit, profit, profit. Here there's surplus, surplus, surplus. And the second thing is that in profit-making entities, they make dividends. They give dividends to their shareholders, whereas there is no dividends in non-profit entities, right? Because they don't make profits. That's not their purpose. That's not what they stand for. That's really not what they do, right? So yeah, to continue. So this is the main difference. Now to explain how you do this. Firstly, it's very, very important to know our formula. So I'm going to try to break this down because with these, the most important aspect is for you to actually practice. If you don't practice, then you're probably not going to get the full marks. The more you practice, the more you guarantee that you're going to get the full marks, because these are usually out of 6 marks, 4 marks, you know. So firstly, you need to know, you need to split these by 3. So it's what I teach my students. You start off by the trading account, then you start off by the profit and loss account. Okay. And then you continue with the dividend, with the appropriation account. Okay, so this is how you set it up. So let us begin. So first you have the first formula, which is that I'm gonna just yeah, which is that gross profit is equivalent to sales revenue minus cost of goods sold. Okay. Then you have profit before interest and tax is basically gross profit minus expenses. Then another formula you have is, this is a really, really, really easy one, is basically profit before tax is simply profit before interest and tax minus interest. So super, super easy. Then you have profit for period is basically profit before tax minus tax. So super easy. And then the last thing you have, the last formula you have is basically retained profit is equal to profit per period minus dividends. So that's it. It's really that easy. You have to just know these 5 formulas that I placed in front of you, and really, really, that's it. These are the formulas you should know. Really, that's it. If you want what some of my students do and what I personally do as a student, it isn't the most, like, I don't think a teacher would recommend this, but I would just memorize the order and then just follow. I basically just subtract the first by the second to get the third, first and the second to get the third. You know, that's really it. Okay, so that's really how you do it. It's just really, really easy. You subtract. So this is 1, 2, then you do 1 minus 2 to get 3. That's it. 1 minus 2 to get 3. Right? Oh no, that's not how it works. Sorry. So you do, see, I made a mistake. So be careful. Basically, it's 1 minus 2 to get 3, right? And then the same thing here. So basically, you do 1 minus 2 to get 3. So you get it? This is how you do it. Okay, it's really, really, really easy. And you just continue 1 minus 2 to get 3, and then 1 minus 2 to get 3. That's really, really it. That's like the simplest and easiest way to actually memorize how to do this. And the only difference for a non-profit entity is to just replace surplus with profit. So basically, profit replaced with surplus, and that's it. And they don't have dividends. That's the only thing. The word profit, you have to substitute it with surplus, and that's it. Okay, this is how you do it. And now for the structure wise, because these are the structure recommended for the IBO, but I have to still give you some tips. I'm not done with the explanation, you guys. Firstly, if they don't give you anything for dividends, like because usually for the profit and loss, what they do is that they give you a table with all the like numbers. For dividends, if they don't give you anything, like they just don't write the dividends, and you consider it zero, but you still write it. Okay, so because my teacher used to remove me a point for not writing dividends. So don't stop there, just continue if they don't give you right. And then another thing for structure is that, for example, you make sure firstly that your numbers are aligned. Meaning, if you have 800 and you have, let's say, 1,000, you write it like this, okay? You don't write, so this is the correct way, let's say. But you don't do, what you don't do is do this. This is not the right way, okay? I don't know if you got it, but you just have to have the digits right. So this is wrong, okay? So this is just like a small example. Another thing that's very, very important is I have to make sure that basically you write your numbers and everything you're subtracting, you write it between parentheses. Everything subtracted has to be written between parentheses. Everything subtracted. Everything subtracted, everything subtracted. And of course, you have to put the lines just to make it neater and to show the examiner that you know what you're doing, you know your formulas, you understand the nuances, you know everything. So I hope you understood. I hope you're getting my point clear, but this is how you do it. So everything's the same for both of them. I just explained the surplus part and the dividends part. That's the difference between these two. But basically, you just have to make sure that you write them properly. And here you write, and oh, and I forgot one more point, is that, for example, here, these are based on the case. For example, let me do this here. So basically, this is the case you're given, whether it's Jill's Jeans, whether it's like any business you have, you put this business LTD, whether it's a profit-making entity or non-profit-making entity, depends. Then you do statement of profit and loss for the year ended, and then you put it depending on what they give you in the case. Okay, then here you put whether it's US million, US thousand, Euro million. So this also depends on the case. It can be in pound sterling, so it depends on the currency and the way you're writing it, right? So this is stuff that you have to be careful. So I might even write them here just so you know, like on the sidebar. Notice type of entity, follow structure, okay, and apply to case, and that's really it. And everything as I said, but basically you have to know your formulas, you have to make sure you write them in the right order, you have to make sure that it's completely neat because these are really easy to ace, okay? And they just have tricks, so you just have to be careful for the tricks and you have to be careful for your neatness. Now, we have the balance sheet. So the balance sheet, what is it? It's a financial statement which outlines the assets. Okay, so it outlines, or just outline, outlines the assets, the liabilities, and equity of a firm at a specific point. And now we're going to be explaining what assets, liability, and equity of a firm are. So basically, assets. What are assets? You have to know the definition of these. So assets are research the value that a business owns or are owed to, meaning that someone owns them, sorry. So basically, what are non-current assets? Basically, non-current assets and fixed assets mean the same thing. So if they give you a table with all like your info, fixed assets basically stands for non-current assets, vice versa. So they are basically long-term assets that last in the business for more than 12 months. So more than 12 months. Okay, so over a year. Examples are buildings, equipment, vehicles, and machinery. Current assets, they're basically short-term assets. They last up to 12 months, to maximum a year, maximum in a business. They include cash, debtors, and stock. Basically, cash. It's money received from the sales of goods and services, which could be either held at the bank or by the business. Debtors are basically individuals or firms that bought goods and credit and owe the business money, meaning that they took the goods before they paid for them, so they still have to pay the money to the business. Okay, that's why it says O2 in the definition. And then you have stock inventory, so includes raw materials, semi-finished goods, and finished goods. There's so many things you can talk about in stock. You can talk about stock specifically, but this is it for assets. Now, liabilities. So liabilities are basically a firm's legal debt. That's their definition. Non-current liabilities, they're basically the same as assets. They're long-term debts or borrowing payable after 12 months by the business. So basically, they're payable after 1 year. They include long-term bank loans and mortgages. Current liabilities, they're short-term debts by business within 12 months that they pay them. They include creditors, bank overdraft, and tax. So total liabilities, like total assets, they're just non-current assets plus current assets. Here's the same. Non-current liabilities plus current liabilities. And net assets are total assets minus total liabilities, and net assets have to be equal to equity. Basically, if net assets are not equal to equity, then your balance sheet is wrong. Okay, these two have to be equal, you guys. They have to be equal, or else your balance sheet is wrong. Okay, so now let us begin. So now equities. Equity is basically it refers to the amount of money that would be returned to the business if all assets were liquidated. Okay, so types of equity include share capital, which refers to the original capital invested into the business. So what is paid to invest in the business through shares bought by shareholders. Basically, what shareholders pay in order to have a share in the business, the amount of money they pay in order to have a share in the business. Retained earnings are basically retained profit for profit-making entity or retained surpluses for non-profit entity. Because again, remember that non-profit entities do not make profit. It's very simple. So for profit-making entities, equity is equal to share capital plus retained earnings. Okay. But for non-profit entities, just share capital because they have no retained profit. Okay. Now, liquidation. What is liquidation? Liquidation is a situation where all a firm's assets are sold off to pay any funds owing, right? This usually happens when the firm goes bankrupt. So now we have a format of the balance sheet. This is the format. It's basically what you have to know to begin, guys. I need to start explaining this. It's basically you have profit-making entity and non-profit-making entity. So first, what you do is that you write your whatever LTD you have. So it depends on the case, and this is also depending on the case. But you have to write statement of financial position out, and then whether it's profit-making or non-profit-making. Then you start with your non-current assets. So basically, we discussed non-current assets. It's anything, any assets that last up to more than 12 months. Okay, any asset lasts up more than 12 months. Okay, it can be buildings, it can be many other things, machinery, and then you have like accumulated depreciation, and then that's it. So basically what you do is that you write like whether this is million, whatever this is, then you just put them all here, and then you put a line, and then you add them. So you just like, or you subtract. This is in this case accumulated depreciation, right? Then you have after that current assets. Okay, so you have cash, debtors, stock. Why is cash up? Cash is up because it's the most liquid. And be careful, you have to follow this order for the IB. Debtors is less liquid because they have to pay them back, and stock is the least liquid because it's basically held up money, it's held up cash, because basically the stock might be stored yeah, basically it might be stored, it might not, it's just waiting to be bought. So basically, and it has a value, its value is money, it was bought with money, it was bought with cash. So basically, instead of the business using like this cash to for productive activities, it's held up in the stock. That's why the stock is least liquid. So then current assets is basically cash plus debtors plus stock. Okay, that's why it's in this case 20 plus 15 plus 55. That's why you get 20, that's why you get 19. So you put a line showing that you're adding them, and then you get 19. Okay, so I have to explain one more thing, is that sometimes, for example, they might give you cash, they might give you stock, but they might not give you debtors. This means that there's no debtors. So you can either write debtors and put 0, or you can just not write it, right? So then you have total assets, which is basically non-current assets plus current assets. And it's the same here. So it's the same in the non-profit entity. Now for current liabilities, so you see it's non-current assets. So I'm just going to put acronyms for you guys. You have NCA, then you have CA, then you have CL, then you have NCL, then you have total liabilities. Okay, just ignore this, but yeah, basically. So basically, to continue, so basically, current liabilities are basically liabilities that last for less than a year, less than 12 months. Basically, you have bank overdraft, trade credit, short-term loans. So it depends. Usually it's like short-term loans, but you have to know all of these. Sometimes they have both, so it really depends on the case, but in the end, you just end up adding them. Current liabilities. And then you have non-current liabilities, which are basically long-term. So they last for more than 12 months. So borrowings. So total liability is basically um current liabilities plus non-current liabilities. I'm just giving you an acronym, but you have to write like the full thing. Then net asset, then basically you have to put your net assets. Basically, net assets is basically total assets minus total liabilities. Okay, then you have equity, so you have share capital, and then you have retained earnings, you add them, and then they have to be equal to your net assets. If these two aren't equal, then your balance sheet is wrong. You have to review your work, right? So yeah. Then for the non-profit making entity, the difference is that in your equity, you only have retained earnings. You have no share capital. Okay. So yeah, that's really the difference, right? And here I said something wrong. I said that basically equity equals retained earnings, not share capital. Because again, they don't have share capital because no one's making money out of it, right? They're non-profit. Now we're going to be talking. So I actually hope you understood the format of the balance sheet. So what you have to do is it's quite long. It's quite a process. But basically, then you have here net assets. Then you have all of these. So basically, you have to first find your total assets, total liabilities, then your net assets, and then your equity, and these two have to be equal. Okay, that's it. And always forget, you have to apply these to the case, these two, mention if it's a profit-making entity or not, and then you have to make sure that you're showing your calculations in this way. This format is the best way to show your calculation. Okay, that's really it. And make sure that you follow whatever the case gives you. Now, we have, okay, so now what do we have? We have the assets. So what are intangible assets? Let's go over these now. So basically, intangible assets are assets that are non-physical in nature. The first type is patents. You have to know how to define these, by the way. Patents, they provide inventors with exclusive rights to manufacture, use, sell, and control. So these are very important to say. Manufacture, use, sell, control. So if you want, you can just remember this like acronym MUSC, the product or process they invented. The inventors are provided with legal protection that prevents others from protecting their idea, from using their ideas. anyone wishing to use the patents, holder's idea must apply and pay a fee to be granted permission to use it. There's a useful life of the patent. It's about 20 years, and goodwill. So, oh yeah, sorry, that's something else. But so basically, its useful life is 20 years, about usually approximately, depending on the country, the law. And they have to apply and pay a fee to be granted permission. Now, the second type we have is basically goodwill. So the value of positive or valuable attributes that relate to a business, right? Something that relates to the business. So basically, the during an acquisition, basically acquisition is when a business is acquiring another one, so they're buying it basically. And when it's hostile, it can be a takeover. So basically, goodwill is valued as the amount paid by the purchasing firm over and above the book value of the firm being bought. Okay, so basically they check how much the firm is actually worth, right? They see, okay, the firm is actually worth 3 million, but their goodwill is really good, their brand awareness is amazing. So we're gonna pay 3.2 million just for the goodwill, right? So that includes a strong brand name, highly skilled employees, desirable locations, a good reputation, and good customer base relations, because this can help the company acquiring it, their owners acquiring it in the future. Okay. And then you have, so these are really, really important, guys. Then you have copyright laws. So basically, legislation that provides creators with the exclusive right to protect the production and sale of the artistic or literary work. So basically, it's like an exclusive right to protect the production and sale of it. It's like an artistic or literary work, like this type of work. Copyright laws will only apply if the original ideas are put to use, okay? Anyone wishing to use a copyright holder's work must seek permission to do so. And basically, most copyright lasts between 50 to 100 years. So different from the patent, which lasts for 20 years. Now we have trademarks. So basically, trademarks are a recognizable symbol. So basically, like Nike's check, word, like Nike's just do it. Oh, sorry, that's a frame. Nike's just do it. That's for the phrase. Or design, like Louis Vuitton's design, right? That is officially registered that identifies a product or business. Trademarks can also have distinguished one from another. So brand awareness. Here you have brand awareness. Trademarks can be sold for a fee. Trademarks can last for 15 years, so basically, but it's renewable depending on their use. Intangible assets are difficult to value due to their subjective nature. Some people may find them important, some people may not. Because again, they're intangible, you can't touch them. Their value can fluctuate over time, and simple changes in the reputation of a brand can inflate or deflate a firm's value, like the goodwill. So basically, if the reputation of the firm is not doing well, they're known for not being sustainable, for example, they're not doing any CSR. So this may actually debunk the value of the firm. Hence, intangible can be used to artificially increase the value of a firm before purchase. Okay, guys, so basically we still have depreciation, which is the HL only part. So I'm gonna make a video just for that. Okay. Thank you so much, guys, for watching. I hope you liked the video, and if you want more for depreciation, tell me, because I'm probably doing it right after this video. Bye bye, guys. I hope you enjoyed. Bye.